The rebound continues on Dalal Street. Markets are up for the third straight week. And in the last 3 weeks, the Sensex and the Nifty have gained 8%. Will the momentum continue? Hello and welcome to the Editors Roundtable, where we put the spotlight on key factors moving the market. With me is Anuj Singhal, I've got Prashant Nair, Nimesh Shah, as well as Nigel D'Souza, and I am Reema Tendulkar. Hi guys.
Hi guys.
That was an awkward pause.
I thought a sting will play out, so that's why.
That's what we rehearsed.
Yeah, that's what we rehearsed. So, but anyway, it's been a good week, yes, and Reema, as you pointed out, and the market continues to gain. It's just remarkable the way everyone's having this FOMO feeling. 16,500, now 17,500. We don't know if it's going to be 18,500.
The dips happen pretty much all days of the week, right?
Yeah.
But every day, without fail, the dip got bought. And the market ended significantly higher, or like Friday when the market, ended slightly higher, flattish kind of day. But it was up. I mean, the impulse is to buy, really.
Yeah, that's right. And the FIs, they're showing us the money, right? After a while, we're getting used to that $1 billion of selling on a weekly basis. Suddenly, in the last 6-7 trading sessions, you have $1 billion of inflows. And as you said, 200 points, on an average is the dip we get in today, and it's getting bought into. I remember, Anuj, a couple of weeks ago on the show, we were discussing that this is the real thing. It seems to be that's the case, right? Because we're 1,000 points higher from there.
It at that point looked like stealth bull market. Now it looks like it's the real deal. Who knows?
You know, the big problem this week, a lot of people who are sitting on cash are now hurting themselves. You know, this was a big peak. After we rallied 10%, everybody thought 17,200, we are at a peak. This week, the big common theme, at least to feedback to me, was markets peaked out. Markets have peaked out. You know, it won't rally from here. And that is why markets are not obliging. So what you pointed out, every day, intraday, there was a bounce back. That's exactly what, markets will not oblige the consensus. Everybody is sitting on sidelines, and hence market I guess market will tend to outperform.
So we made it to 17,400. This week, the benchmark indices rallied 1.4%. The mid-caps gained more than 2%. The question is, what next? Can the rally continue from here on, Anuj?
I think it can. Obviously, as Nimesh said, because people have missed out and there's a FOMO factor, maybe the market continues to surprise. I'm looking at two interesting themes right now. The first theme is from CLSA, and that's a technical view from Lawrence Belango. This is a very interesting trade, which Lawrence points out that globally a mean reversion trade is playing out, and that trade is basically the first half's big losers who are leading the rally, and first half's big gainers which are falling. And in that, an example is Brent crude, which gained 50% in first half, is down 19% since, and you have Nasdaq, which fell 30% in first half, has led the rebound. It's up 19% since. It makes a very interesting point about where the market is. The Nasdaq is trying to test its 200-day moving average from the way down, which is 7% away. And the US bond yield, which really, these are the two key indicators, US bond yield and Nasdaq. And bond yield is falling, and that is going to test perhaps its 200-day moving average. So his point is that at some point, they will converge at 200-day moving average, and that will end the rally. That's just one theory. I've looked at the Indian context, and in Indian context, while one part is true that the big year-to-date losers have bounced back, like the IT names, whether it's Tech Mahindra, Wipro, HCL Tech, they're all up 10 to 12%. But the big gainers year-to-date have continued to gain. Mahindra and Mahindra, for example, has been the biggest index gainer, and that's been the big gainer this week as well. So, in some part, it applies to India as well, but not entirely. And just finally, the couple of stocks that I'm tracking for next week, if this market has to extend its rally, I think HDFC Twins need to fire. For HDFC, this has been the biggest underperformer for the week, for the month, for the year. It's 22% away from its all-time highs. It's a stock which is trading below its median valuations. Normally, it does not do that, and repeatedly holding its 200-day exponential moving average. Now, the reason I point this out is normally HDFC outperforms when FIs come back. That's the go-to stock, the first stock that FIs buy when they come back. This time it hasn't happened, which is quite strange. And the other one is HDFC Bank. I think very clearly ICICI Bank has taken over the leadership. It's outperformed HDFC Bank by 15% this year, and over 2 years by 100%. And its valuation now is at par with ICICI Bank. And the FI holding in HDFC Bank is now at multi-year low, in fact down 8% from peak. So the market has to move. My sense is that HDFC Twins have to fire. But Nimesh, what do you have for us?
So, just to take a point forward, that's what probably can happen. The FI money is back. At least there is, for this week, we saw $1.4 billion of buying from the FI. So at least there is a start to what they've been not been doing for the last 6-8 months now. So that's one thing. The other interesting data which I saw in some of the reports was, for the first time, the DI holding in Indian equities is now at the highest. So the gap is now inched up to 4 percentage point versus the FIs. Remember, for good 25 years, the FIs were the bellwethers of this Indian market. They were owning a large chunk of the Indian equities. That has now changed with a lot of retail investors putting money into domestic mutual funds. So that's one big data. The other big theme is, what if the FIs have to come back and aggressively buy the Indian equities in the second half? Remember, for India, the falling crude, the falling commodity prices is all positive at the margin. And that is why, I was chatting with some large, insti heads on what are they anticipating from the larger FIs. Remember, for this year, they've sold $30 billion. The guesswork is, even if the $10 billion is to come, it will be huge inflow into the Indian markets. We just at the tip of the iceberg of just 1.4 billion, and we saw what markets have done, right? So, Anuj, to some extent, maybe if the FI money comes back, the HDFC twins, those large caps will bounce back. And remember, the FIs have aggressively sold the big holdings into the financials, the big large IT names and all. So the money will obviously chase those same stocks. So the other data point, this week, so much of blocks have happened, the deals have been offered, and it got lashed up. Look at Zomato, 3,000 crores of deal just got cleaned up in 2 minutes in the morning trade, and some large marquee names have bought, right? So that shows that the risk appetite is back, and retailers have still not participated. So these are the two big things to watch out for. The FI money is back, and the retailers are still sitting on the sideline. So maybe, it'll surprise on the upside. That's the overall feedback. But the way money is getting committed, the blocks are getting absorbed, looks like the FI money is coming back, and that's a big thing to track.
General participation, Tiger Global sold stake in, they cut their stake in half, and they sold on the screen, right?
Correct.
Not even...
and it got sold.
It got sold
So
without a broker.
Is getting sold, So this is one thing, the return of FI money. The other big thing which a lot of people have been talking about is the new age companies, seeing a bit of a comeback. Most of these stocks have rallied 30-40% from the 52-week lows. The Zomatos, Paytms, PB Fintech, all have moved up. I guess maybe you can throw some more light on the 10-year US 10-year yield, and a lot of people are correlating that to the Indian move as well. So maybe that's something to track. But I guess the one big thing for me is the return of FI money, and that can actually surprise on the upside.
The sense you got is the Indian markets, they said to the FIs, well, if you don't love me anymore, we let you go. But if you return, you'll be mine forever, And it appears at least that's what's played out clear. Just on a lighter note, guys. But, I've used it in my life many times. Prashant, you've got more, I think.
No, I'll take that point which Nimesh highlighted forward. I'll move on to the wall. So this is not something which will kind of matter to us immediately, but I think this is something which will matter to us as we go into the end of the year over the next many months or so. What are we talking about? The number will come up on your screen. 1 lakh crores worth of free float is going to appear magically available to be traded between now and December 31st, 2022. Let me explain what this is. This is nothing but shares which private equity investors, venture capital funds, etc., had sort of bought into all these companies and more, and which were locked, and then these companies IPO'd, and as SEBI rules said, all pre-IPO capital is locked in for 1 year. That rule, of course, changed in April when that 1 year became 6 months. But the fact is, for the purpose of this analysis here, we are just looking at what is the total amount of free float which will be available. I mean, this free float it's not existent. I mean, you can't. This 1 lakh crores is out of the market because it's locked in because of regulation, and this becomes free to trade between now. And I'm not going into individual dates, but I mean, to get you the bigger picture, between now and December of 2022. I mean, you total this up, it will not add up to 1 lakh crores because I've kind of not included many other names for the purposes of brevity. But the fact is, the biggest ones are these. Paytm, some 66% of its equity will be free to trade, available to trade. That's worth 34,000 crores. Delivery, 39%. That's worth 17,500. There's PB Fintech, Star Health, Aptus Value Housing, Nykaa, Sapphire Foods. This is not to say, I want to make it clear, that 1 lakh crores worth of stock is going to be sold. It's just that it's going to be counted as free float, available for trade and not locked in. That's the important point. I mean, just to take that point forward, the reason we can't say that 30% will be sold or 40%, 50%, a couple of factors. the dynamics and motivation for every investor, private investor, public market investor, venture capital investor is different. Fund life is something to consider. Many of these funds have reached their full life cycle. 10 years typically is the life cycle, and then you get maybe 2 or 3 years of extension. Overall, global cues are very important. I mean, we were talking about the 10-year global financial conditions, etc. I think important to note performance of the overall fund. It's been an issue for funds like SoftBank, for example, Tiger Global globally. So, I mean, if you're doing very badly in other parts of your portfolio, I mean, you'll take money where you can. So that is the other consideration. And 2 specific things. SoftBank's actions will be closely watched because they've been such an outsized large player. And Alibaba's actions, I mean, what Alibaba does with, some of its holding, I'll detail what these 2 own, will also be important. I mean, India-China tensions. Alibaba, of course, is facing enough and more heat back home in China as well. This is basically just these 4 names that I highlighted. SoftBank holds 10% in PB Fintech, in 17% in Paytm. Tiger Global owns a chunky 7% in PB Fintech. Alibaba in Paytm, 31%, massive, right? And Sequoia is owner of almost 14% in Go Fashion. All of this, as I said, will not come to the market, but a portion of it most definitely can. And the point really is, if any portion of it comes to the market, you will need flows. You will need money to be absorbed, right? I mean, foreign or local, as has happened with Zomato, which, I mean, got executed without a problem. But the fact is, I mean, even a portion of this is quite substantial, which could hit the market. And I don't think that's a non-negligible kind of risk. Rima.
Well, I'm just going to take a look back at the week gone by and tell you about the earnings hits and misses. Well, the big gainer this week was M&M in the large cap space. The stock gained close to about 6%. For the year, the rally stands at about 47%. While the results were largely in line with expectations, there was a bit of a margin miss. ITC was another stock which hit a 4-year high post the results. And the key highlight for ITC is that all the segments did well, whether it's FMCG, whether it's cigarettes, the paper, as well as the hotel business. Interglobe Aviation had a rally of close to about 10% for the week. It reported its highest ever quarterly earnings. The domestic travel is better than pre-COVID levels, while international has reverted back to COVID levels. And of course, crude prices have slumped big time this week, and that's aiding the up move in aviation names. It was, of course, a big week for Zomato, as we've been talking about. Tiger, Uber exiting, but numbers look good from Zomato, and that helped the stock rebound close to about 16% from last week's low. Last week, Zomato hit a low of nearly 40 rupees. So from there was a big up move that we saw in Zomato. Britannia, on the other hand, was a big miss. The volumes declined 2%. There was a gross margin decline, and the stock slumped 4% for the week. Lots of others on the mid-cap end as well. So a few mid-cap misses were Siemens, Voltas, Industars was down 10% for the week. On the gaining side, in terms of mid-cap hits, where the earnings look very good, IDFC First Bank, Chola Mandalam, Manappuram, Kansai Nerolac had gained about 25%. And in earnings for the next week, well, it starts with Bharti on Monday, but you've got a couple of metal names like Hindalco, SAIL, a few pharma names like Aurobindo Pharma and Divi's, which will report numbers. So that's the earnings report card, but you're tracking paper.
Well, that's right. When we were growing up, we used to make those paper rockets and, throw them around. And that's the way paper stocks actually, they behaved all of this week. And I'll tell you why. All those stocks, in fact, they had a big rally. And they were up anything between, 10 to around 15% or thereabouts in the past week itself. Some of them should come up for you on the screen. And if you're looking at it even on a year-to-date basis, well, some of those stocks are up close to around 90%, 80, 90%. The lone underperformer out there is Orient Paper on a year-to-date basis. And there were a few results that came out as well, and the numbers look pretty good. Whether you're looking at JK Paper, SSI Paper, and ITC, the entire focus was on the FMCG business, cigarettes business. Well, the paper business as well did do pretty well. Century Paper, well, they came out with a presentation, and out there it was quite interesting because the domestic prices of paper are now at a bit of a discount in comparison to the export prices, which is giving you a sense that maybe, in fact, paper prices have got some bit of a base. Otherwise, you're worried that export prices are at a discount. And the rupee depreciation, well, that as well could be a bit of a tailwind. But for the time being, the spot prices, this week itself, there was a price increase. So Q2 prices will be higher than Q1. The rupee depreciation, well, that's what could help exports. So those that are exporting will, it'll benefit them, while imports become far more expensive, and also freight costs have gone up. So imports will be restricted as well. Now, domestic factors are playing out. There's a reopening trade. Schools have started, colleges, offices as well. So paper consumption is going out. The new education policy, we had the management of Navneet Education. They said the next 3-4 years should be good for them. The new education policy will spur paper demand as well. You have plastic ban out there, which will help packaging, of paper as well. And the European gas crisis, well, that's what will restrict supply. There'll be a bit of a shortage out there, which could help Indian domestic paper companies as well. The restriction on prices, that could be a bit of a risk. What if a cap is put in place? If there's a slowdown, it hits demand, it hits prices as well. And what if the sanctions are removed? Then supply comes back in, and that's what could put some pressure. In terms of valuations, well, they trade in double digits, but that's on a trailing basis. On a forward basis, it could be at mid-single digits because they have product mix, you have cost-saving measures as well. But on an EV per ton basis, they trade at a bit of a discount in comparison to replacement costs. So that's something as well that you should be tracking. Like in cement, paper could be another EV per ton that you're tracking. But guys, back to you.
Okay, Nigel, the advantage of having two young kids is that I still remember how to make. I made this while you were doing this line. I know, just one point. You said, they fly, but they come down also very fast. So you should know when to exit.
Absolutely, and you made that point as well, Anuj.
Yes.
All right, on that note, we'll get into a very short break. But on the other side, we'll discuss more about the markets. We've got a very special guest joining in, so don't go anywhere.